Lesson number 2, basic features of futures. Here what you will learn in this lesson: what is a futures contract, what is the purpose of futures, and contract specifications. Let's first see the basic definition and the main features of a futures contract. The standard definition states that a futures contract is an agreement between two parties to buy or sell a certain asset called the underlying, which may be financial or physical, at a certain future date at a certain price. In other words, a futures contract is a means to purchase something in a further moment in time at a price decided in the moment we create the contract. What we've just seen is the manual definition of a futures contract, but to be stringent, it applies only to a specific context, the one in which the two counterparties keep the contract open till the maturity, the underlying asset can be transferred, and it is exactly the intention of the two counterparties to transfer and to be transferred the object of the contract. This is typically the answer to a specific need to be able to buy a certain asset at a certain future date and at a price decided a priori, or to be able to sell a certain asset at a certain future date at a price decided a priori. These are typical needs of companies that want to protect themselves from risks of some kind. It's a way for companies to decide today the price at which they will purchase or sell something at some moment in the future. But in most situations, a futures contract is only a vehicle to speculate on the performance of a certain underlying in the short or very short term and with a high leverage. The price trend of a futures contract, the futures price, generally moves hand in hand with that of the underlying, the so-called spot price, but takes on a different value. It can be greater, equal, or lesser, depending on the contingent situations and depending on the specific characteristics of the underlying asset. The idea is that the futures price goes in the same direction and generally with the same amount as the spot price, but in the beginning, the futures price is not equal to the spot price. It can be greater, equal, or less. It depends from case to case. And of course, we will take up these concepts later. Futures are standardized contracts listed on regulated markets. This means that for each contract, everything is fixed in advance, fixed by the issuer, which is the exchange. The good to be exchanged, the quantity, the quality, in case, if applicable, expiration dates, minimum price variations allowed in the book, the so-called tick, maximum number of contracts exchangeable in a day, maximum daily price variations allowed, and so on. Part of the regulation is also responsible for managing the risks generated by the very high intrinsic leverage of these instruments. This is the so-called mark-to-market, which we will see later. The futures have a maturity to which they are closed, regulated, and they can be regulated either with the delivery of the underlying asset or with monetary exchanges, and withdrawn from trading. Then a new series of futures is issued in the market. If the underlying is physical and or transferable, just to say cereals, metals, currencies, ETFs, and also shares, a physical transfer of the underlying may occur between the two counterparties, but in several cases the settlement at maturity is simply monetary. The exchange of goods through derivative contracts can only take place between economic subjects. They are called commercials, registered in particular registers. Private investors are not allowed to bring to maturity positions in derivatives that provide for physical exercise on goods. You cannot keep a futures on corn till the maturity, because if you did, you would have the obligation to purchase some amount of corn. If necessary, their positions are automatically closed by intermediaries at the appropriate time. Usually in a specific day of the month, it's the last moment where you can close your positions. If you do not close them, they are automatically closed by your intermediaries because you cannot keep contract open at the maturity. Contract specifications, an example, futures contract on the FTSE index. This is the main Italian stock index. The underlying is the FTSE index. The quotations are in index points. Each point is valued €5. The minimum possible price variation, the tick, is 5 points, worth €25. The contract size is the price of the futures multiplied by the value of a point. So for instance, if the future quotes 20,000 points, the value of the contract is €100,000. Listed maturities every quarter of the first year, then every 6 months for 2 more years, then every year for up to 5 years. The expiry date is the third Friday of the expiration month. December 2019, for instance, is the 20th. Settlement price at maturity, it's the opening price of the underlying on the expiry day. The settlement value of the contract at maturity, it's the opening price of the index on the expiry day. The settlement at maturity is monetary, and the initial margin, a very important concept which we will spend a river of words later, is variable, usually between 10 and 15%. Initial margin, just to give it a first definition, is a measure of risk. The range of variation for its value responds to the need for a risk coverage system that adapts instantaneously and consistently with the riskiness of the market at all times. Look further for more details. Let's now see another example referred to as stock futures, a futures contract written on one of the main Italian companies, Eni. The underlying is a lot of 500 Eni shares. This means that with one futures contract, you are taking control of 500 shares. Quotations are in euros and fractions of euros, and the price in the book is per share. The minimum allowed price change in the book, the tick, is 0.0001. The contract size is the futures price multiplied by the lot. So if, for example, the futures price is 15.27 per share, the contract value is 15.27 times 500, and that is €7,635. Listed maturities, the 2 closest monthly and the 4 closest quarterly. Expiry day, the third Friday of the expiry month. Settlement value of the contract at maturity, it's the opening price of the stock on the expiry day. Settlement at maturity can be monetary or physical. Both types are listed, so you have to be aware of what you are picking. If you are picking the physical settled, then at maturity you will be assigned of some number of shares of the underlying stock. Initial margin, which we will discuss in the next lesson, is variable, tendentially much higher than that on index futures, since the riskiness of a single stock is usually much greater than that of a basket of 40 or more stocks. Remember, as previously stated, that initial margin is a measure of risk. The higher the risk, the higher the initial margin. The main difference between stock futures and stock index futures, as can be seen from the first line of the above list, is that for the former a lot is defined, equal to the number of shares controlled with a single futures contract. The lot can change from a stock to another as it happens on the Italian derivatives market, or it can be standard as it happens in the US derivatives markets. Usually in the US derivatives markets you have a lot of 100 shares. On the Italian derivatives markets, you can have 100 shares, 500 shares, 1,000 shares, 2,500 shares, 5,000 shares, and so on. For now, that's all. We are going to speak of the initial margin and everything that comes with it in the next lesson. Thank you for your attention.